Hi, everyone, and welcome to the Haus monthly private investor newsletter, where we remove the noise from questionable media clickbait campaigns to help people make smarter property decisions. As always, we will be diving into the current state of the Australian property market from the eyes of a business that are analysing and negotiating on properties daily to help you make sound investment decisions. So experience does tell us that it's critical to seek education and knowledge to understand what drives the Australian property market, to identify opportunities and confidently. So as a valued member, we're able to share with you our top future growth locations under 500,000, as well as under $1 million and also under $2 million. So keep an eye out for that throughout the video, and let's jump in, shall we? So the Australian property outlook, I'm just going to run through where we're seeing it sitting at the moment, given it's January. Is it the January edition? With 2022 behind us, we're going to take out our crystal ball here in this month to assess what to expect for 2023. So what we see at the end of 2022 is the same property market trend continuing into 2023, with reduced level of demand for housing expected due to the lack of consumer confidence and also available household cash flow. To this as the post-New Year's hangover, where people are recovering from their Christmas and New Year holiday spending sprees, as well as adjusting back to the new world after a number of weeks off. So what will continue to put a dampener on the property market is that inflation still remains relatively high, and potential interest rate rises in 2023 still dominate the investor's mindset. We believe that the coupling of these factors will continue to affect the market sentiment and constrain property price growth in the early parts of 2023. It's also really important to note here that in any market that someone looking to sell. So please don't think that there are no good opportunities out there to buy. We've been negotiating some really great purchases for clients over the past weeks, and you just need to be active and persistent. So keep that in front of mind, and don't just discount the market just for the sake of it without actually knowing what's going on. So we can still see great opportunity in this market, as the shoulder season that we are in, it just won't last for long. The markets do move in cycles. So we're in this period now, it will shift as it always has. You just look back on history. There's ups and downs, peaks and troughs. And time does tell us that fortune does favour the bold in property markets. So we should start to see a shift to a more neutral market coming into the back end of 2023. And as a result, good buying opportunities will be harder to find as competition increases alongside that consumer confidence. So if you have the ability to act now, either reach out or just keep looking, and as I said, be active and be persistent in this market. To build this out a little bit as well, it's important to keep in mind that there are markets within markets in Australia. The end of 2022 saw negative sentiment towards the property market. However, I have to point out that the year-on-year growth rates in some of our growth locations, it reached double-digit capital growth levels throughout 2022. So that's month on month from January, December over the past 12 months. So just don't think that what's in the media it's going through that we are seeing negative growth rates. We're actually seeing positive growth rates in some of the markets. So just keep that in front of mind. And it also points to the asset selection part that we're always harping on here at Hello House. So key asset selection is obviously critical if you want to get the most out of your investing. A good point is the opportunity cost that people don't understand. If you're just investing anywhere for the sake of putting your money somewhere, there could be that opportunity cost that you're missing out on, which we've covered in previous videos as well. However, look, we expect growth to continue throughout 2023 in only a handful of locations around Australia. So it's really important to focus in on that asset selection and then leave the data as well. A final point to hit home with our expectation is rent rises throughout 2023, with vacancy rates around Australia still at record lows, and low housing supply levels, coupled with we've seen 155,000 migrants enter into Australia over the past 6 months from July to December 2022. So their prediction there was 200,000 per year for the next 3 years. So within 6 months, we're obviously over targeting that, and the 200,000 seems to be more than reasonable. And I'd expect to see probably a bit more than that 200,000 migrants coming into Australia come June 30, 2023. But yeah, just keep that in mind that we do have these constraints coming through. Our national rental crisis is quite real, and is expected to continue with these migrant levels coming through as well. So this metric is also a leading indicator for capital price inflation, as renters discover ways to pivot out of the rental market and become homeowners, which is the Australian dream, and that will put further pressure on capital values in the future. So looking at basically 12 months time just to see that start pushing through more and more, and then you'll see the sentiment change. But it's kind of at that stage. It's too late, but there's always times to act as well. If you're trying to find the bottom of the market, you never will. Just be active, and when you have the propensity to invest, then obviously do so, but do it in an educated way and work with people that obviously are in the market every day as well. So jumping into the points of interest, which we cover in the newsletter as well. Look, interest rates. The Reserve Bank of Australia's cash rate continues to sit at 3.1% this month in January. They won't meet until February, which is still below the 32-year average of 3.85%, and that's calculated from 1990 to 2022. So it's hard to see many more rises coming through in 2023. More just commentary around the possible future rise. So let's just keep an eye on this one. I would expect a 25 basis point rise come February, and maybe another one towards March, April. But I just feel like they're at that peak now. So let's just watch this space. Nonetheless, they are approaching their peak. So hold on, refinance or renegotiate with your lender if you can, to try and basically decrease that expenses in your portfolio. But yeah, look, have faith that the continued capital growth will be there for those with the right assets to see the forest for the trees. Key point is the inflation rate, which everyone keeps talking about in the media. Look, last month, we saw the inflation rate surprise people. It's dropped down from 7.3% to 6.9%. However, we're still above that 3% Reserve Bank target. So look, if you zoom out and look at the inflation rates, the trend is still in our favour. So it's a downward trajectory, but obviously we're still a few percentage points away from that 3%. So we do need to curve that inflation rate in order to sort of get back to that new normal, and also for consumer confidence to increase. But it is set to peak, the inflation rates, as mentioned, late 2022, early 2023. So that's where we are right now. So let's just keep to monitor anything that goes on. But look, the bond market is pricing in interest rate cuts come 2024. So look, there's not a lot of stress there on my end as it going through the roof anytime soon. It's just peaking off now. So that's sort of my thoughts around that one. Next, the metric I like to look at is also the auction clearance rates. So CoreLogic weekly clearance rates of the combined capital cities at the moment at 55.8%, coming into the end of December 2022. once again, indicating a neutral market, not in favour of buyers or sellers, really, which is sort of what we're seeing as well. And to build that out further, look, I break that down in the newsletter as well, but below 40% is really a buyer's market, and above 75 is a seller's market. So obviously we're in between that. Now the government agenda, I like to sort of look into, what they're looking at. Look, it's pretty straightforward. It's continuing to bring down that inflation rate, and focusing on their long-term infrastructure goals as our population grows. And as always, continue to seek that re-election in 2026. So you've got to play the game with the government. There's always policies coming out, but they're just human beings at the end of the day. So you've got to look at it from that common sense mindset. Overall, the buyer interest levels we're seeing are moderate. So we're still seeing buyers obviously in the market. We're competing against 2 or 3 buyers on majority of deals, as opposed to 12 months ago where there was 10 plus. So it's definitely not a dead market from where we see, where you're actually only bidding against yourself. So just take that as you will. The sellers' motivations are low to moderate, and by meaning that, look, people are always selling different parts of their life, right? So does it have to sell because they've bought elsewhere, or they want to either downsize because they're retiring, or they need upsize because their family's growing? Those basically people that are always transacting in Australia. So that's why there's always good deals to be had. You just got to be active and find it. And this is pretty normal for the Australian property market. Most people have just come out off the highs of 2020, 2021, where we saw record growth rates throughout Australia. So just understand that we are entering back into that new normal, and to expect these sort of growth rates that sit in those single-digit growth levels. Obviously, we like to put our clients into those higher growth locations as well that are seeing those double digits, and we lean a lot on the data. But it's quite important as an investor, in my opinion. Now, I also like to what to focus on and what to avoid in the newsletter. And look, they're pretty straightforward. I won't rattle them all off, but look, focus on good quality assets in good locations. So obviously, once you find those suburbs you are targeting, zoom in and look at, well, where are the best streets in that suburb, essentially, and avoid things like state roads, main roads, local thoroughfares, bus stops out the front for residential, especially. Quiet cul-de-sacs are always good. Don't buy a property without doing your fire and your flood and your easement checks, because look, fire and flood, it's a thing that's obviously prevalent in the Australian property market. Areas know that as well, and your insurance premiums are reflective of that, of your address. So not only the higher holding costs are there, but also if you do have a flood event and your tenants have to vacate and you have to repair the property, whilst a lot of it might be covered in insurance, it's still a painstaking process which you've got to go through. Which, if you can avoid, do that. Other things to avoid is off the plan units and off the plan house developments. But we've seen some good growth in house developments off the plan during that 2021 period, but it's hard to hang your hat on that given the history of those new estates and how they performed over the past 10, 20, 30 years. They just don't compare to your established locations that are already well built out. So if you're looking for different strategies, a lot of people like the tax benefits around that. I'd say don't invest for tax benefit purposes. And there is strategies where you can buy and do a full renovation, and then you can also claim those improvements as a tax deduction as well. So obviously, if you have any questions, reach out to us as well. So that's pretty much the stats that I've wanted to sort of run through in the and where we're seeing 2023. So the juicy part about this newsletter, which you'll see, is those future growth locations, which I like to talk about with a few people. So the top locations that I'm looking at, look, obviously we're looking at number ones. I like to sort of change it up to give people that, I guess, different perspective, but also we're all in different parts of Australia. So some investors do like, especially first timers, to be within driving distance of their locations. So the top three that I've got under 500,000, I still like Perth. There's still a lot of growth coming into that Perth region. And for me personally, there is that CBD there of Perth, and Waikiki is a suburb that is close to the coastline. It's well built out. There's a lot of flood or fire risks there. You've got established buildings that are like 10, 20 years old, so you still get that depreciation benefit out of them. And a lot of it's flat blocks too. So you can either have that renovation upside. There could be subdivision potential as well. But the price point, which is a median house price of $455 there, and the yields are coming in at just over 5%. Look, it's quite attractive still, and you have that benefit of the coastline being there, so that supply risk of being built out or further land subdivisions being put through is just not there in Waikiki. Also have a few key infrastructure projects that are going through. We've got the Aqua Jetty with the City of Rockingham. They're pumping $27.6 million into that. You've got sporting complex upgrades, and also a road rehabilitation and renewal program. So there's quite a number of key projects, and there are so for each of these locations, right? So they have to look at, and pretty strong about is Ipswich and the suburb of Raceview. I do like that suburb, and with median house price, you're looking at $490 on that one. Yields have come back a little bit, just given that there has been good growth out of that. That's one of the suburbs that's grown over 10% over the past 12 months. So, in that down negative sentiment market, this location has showed really strong signs of resilience. So I'm pretty confident moving forward. And they've also got some really key infrastructure projects coming through that Ipswich region as well. We've got the heavy rail Ipswich to Brisbane, and also Ipswich to Toowoomba. And also there's a lot of motorway upgrades, M1 connecting that region a lot more efficiently to Brisbane, Logan, Gold Coast, and Toowoomba. So plenty of work on there for people to get involved in, and for renters to essentially reduce that risk of not being able to pay rent. So something to always keep in mind. Another area I like, jumping into New South Wales this time, is Lavington. So that's in the Albury local government area. The median house price is sitting at $450,000 range. Yields of 5%, so 4.8 is where they're at the moment. And the days on market are still pretty strong there. So you're looking at 36 days on market. It's been a really good performer, Albury, that Albury-Wodonga area over the past few years. It is it's a well diversified area with a lot of different employment hubs, and some key infrastructure projects going through. Like we've got the Riverside Precinct, which is an $8.7 million spend, going to contribute to that livability of the area, and sort of keep a lot of people there long term, and also in employment. But yeah, they're the three for under 500. Jumping into the under 1 million. Look, Pacific Pines on the Gold Coast has actually come back into favour. So it has seen a small decline in growth rates over the past 12 months. So the heat's come out of that during 2022, but the fundamentals are still there for a really good, solid performing asset. So while some people were buying early in 2022 into Pacific Pines, we weren't, and now it's come back. It's starting to see that showing good signs of value as well. So median house price $873,000 on that one, and you can still get decent yields. I mean, I'll be targeting around a 4.5% yield on that, which Gold Coast generally sits around a 4% yield. So you've got really good cash flow coming through, and you've got a solid asset that is now really well built out. Overall, the Gold Coast in Southeast Queensland is pretty key from the infrastructure spend perspective, coming up with the games in 2032. So there's a lot of projects going through, and Tom Tate, the mayor of Gold Coast, he's very pro-development. So we've got light rail stages, we've got heavy rail stages, we've got M1 expansion stages going through. There's billions of dollars being spent on infrastructure. So yeah, just have a look at that one if you are keen in that price point. Another location under that $1 million is Alexandra Hills in Brisbane. Similar reasoning in that it grew quite substantially throughout 2021. 2022 on the back end of 2022, sort of after that September period, started to cool off, and we're seeing good buying opportunities. So a lot of people were heavy into Alexandra Hills sort of in 2021, buying up, and the median house price, it did increase quite drastically. We used to be able to buy for that $600,000 range. Now the median house price is $730,000, but we're still seeing really good value, and yields are above 4%, so sitting at 4.2% on that front. There's also obviously a number of infrastructure projects going through to complement the works required for the games, and also just for livability perspectives as well. So to give you an idea, there's the Town Centre revitalisation project. So there's $250 million just being spent on that alone. And then there's transport hubs and basically parks, recreation, improving roads. There's a fair bit going on there. So have a look into that one as well. And also you've got the comfort of one of Australia's major CBDs just around the corner. So you're always going to have that diversity of employment. East Maitland is another location. We're sort of rounding off the 3 locations for the under $1 million. I still really like East Maitland. It's in that Newcastle local government area, and the livability perspective is quite nice. There's like nice blocks, basically low-set houses, strong owner-occupier appeal, still in close proximity to Newcastle and the coastline there. And it's a nice little hub there. It's basically seen really tight vacancy rates at the moment. It's 1.58%, and the majority of people that do live there, like 64% at the moment, are owner occupiers. So you've got that lower rental capacity, but the whole period there is quite good, which is rounding around 9 years. So based on what we're seeing and where the data is pointing us, I do like East Maitland. And there's a few projects going through there as well, like the Hunter Power project. That's a $600 million spend from the government. There's also the M1 Pacific Motorway extension. That's a big spend. It's $2.1 billion going through there. So we like it, and it's made the list for this month. Jumping into the $2 million, under $2 million. Look, I'm pretty risk averse with my locations. I like coastal locations in well built out either CBDs or satellite city locations. So Burleigh is a location that has made the list this time around. It's got a median house price of 1.45 million at the moment, and that's actually come back. So it's pulled back during this slower period. It saw massive amounts of growth. Like I'm talking 30 to 40% in capital growth over an 18-month period from 2021 through 2022. So you can't expect that level of growth to continue, because it's pointing you towards a massive bubble. So it's come off the boil there. And with this, it is a quite tightly held market. So it's hard to get into these markets. And these times where it is quite, the sentiment is low, I like to really capitalize on this. So you're not going to be feeling like you're getting the deal of the century, but you just know that there's good quality asset selection in a high growth location that's going to continue to perform well, especially as you see the migration statistics coming through, and even internal migration from other states like Sydney, Melbourne, and also people really taste that lifestyle. Like you can literally wake up, walk to a coffee shop, have a nice coffee, go for a swim at the beach, and be home by 7:30. It's a really beautiful location in the world, and also it's being touted as one of the strongest livability locations in Australia, and being Australia's targeted throughout the international community as a really strong place to live in the future. So that's why we are seeing these increased levels of migration coming through. And that's pretty standard for most parts of this under $2 million price bracket. Focus on locations that look, they are still expensive, but it's under $2 million for a reason. But it's hard to get into them. So Oyster Bay is the other one on the list. It's in the Sutherland Shire in Sydney. So just out of Cronulla. It's a beautiful space in the world. And look, it borders the Georges River. So once again, you've got there as well, because they can't keep building land further north into the river, and south and the east and the west, it's all well built out as well. So look, markets pull back there a little bit. It's come back around 7% over the past 12 months, which is quite rare, and I'd like to capitalize on those opportunities, and it's in the list for this month. So if you are down there and you are looking at potentially buying around that Sutherland Shire region, and you're within that 1.575 asking price range, have a look into it, but make sure to focus on your asset selection as we talked about before, and have a read through those key points that we spoke about earlier. The final location for the under $2 million is Tweed Heads in northern New South Wales. This obviously featured last month as well, but I really am bullish on Tweed Heads. I think it's been lagging a few of its surrounding suburbs. There's a bit of negative market sentiment around Tweed, going into like sort of lower socioeconomic, but I see those as really strong buying opportunities, because time has shown us over and over again that with the urban sprawl and with the wealth pushing into these locations that have strong livability. I mean, Tweed is a beautiful place in the world, lovely views, the Tweed River, easy access to the beach, easy access to the M1 that can get you to Brisbane, Gold Coast, even down to Byron Bay, which has been booming. And there's also some really good projects going through. So the Gold Coast Port, which is basically Tweed borders the Gold Coast. They're expanding that airport. There's also the new hospital going in around that Kingscliff region, which is driving a lot of, spend into that region, and also dragging in higher basic wages coming through into the medical precinct. So still strong growth signs. Biggest thing about Tweed to keep in mind is do your flood checks, because it does flood in certain pockets. That's sort of wrapping up all my my top threes under those price brackets. And look, I also like to sort of hit home on a few little negotiation lessons and analysis lessons. So I talk about that in the newsletter as well. But look, the lesson for the month is ask additional probing questions to the real estate agent about the target property that you're looking at, and be mindful of their habit to consistently create competition, as well as the vendor's expectations. So understanding your level of competition and the vendor's expectations is essential in any negotiation. So be sure to ask those probing questions. From the analysis side, look, when you are assessing, and this ties quite directly in, when you are assessing the properties to purchase, obviously analysing those comments from the agents about the competition and also the vendor's expectation is key. But matching that against comparable sales in the area is always essential, to understand where market value sits and to ensure that you're not paying over market value. So don't get sucked in. You got to do a multi-pronged approach in your analysis there through interviewing agents and also looking at comparable sales. So be mindful of that, and don't skimp on time, because it's an expensive asset, hundreds of millions of dollars, and getting it even just slightly wrong can cost you. I mean, you can click your fingers and there's $15,000, which is pretty common in the Australian property market. So, be mindful. And if you have any questions, obviously reach out. Also, check out our Get Buy Ready course, where we break down how to find, analyze, negotiate, and transact on these properties. It is a pretty extensive course. It goes for 3 hours, but I'd say to anyone to, if you are looking at purchasing a property, your mistakes can be very costly. So at the very least, we've got this course. It retails for $995. We've got a code in here that gives you it for $500 off. And if you have any questions, obviously reach out or jump onto our Get Buy Ready Facebook group. And don't ask questions. You don't know what you don't know in this world. We're working. We're here to help, and all the best with your investing. And thanks very much for listening. Cheers.